Okay, let's dive right into this. Welcome to today's explainer. Now, if you've been keeping an eye on the financial markets lately, you know there's just a massive buzz going around about the upcoming IPO for a manufacturing powerhouse called Zetwerk. But hey, instead of just repeating the same old headlines, we're going to do what we do best here: break down the actual source material. We've got our hands on their updated draft prospectus, and let me tell you, this is a dense, 600-plus page legal and financial behemoth of a document. But don't worry, we've distilled it all down into a clear, visual journey to help you understand exactly what's going on beneath the surface of this highly anticipated offering.
So here's our roadmap for decoding this document today. Number 1, we'll meet Zetwerk. 2, we're decoding the IPO numbers. 3, looking at who's actually cashing out. 4, checking out the Wall Street heavyweights involved. And 5, understanding the risks.
All right, let's get right into it. Section 1, meet Zetwerk, from private to public.
So what's happening here is the entity is officially transitioning its name. They're going from Zetwerk Manufacturing Businesses Private Limited to simply Zetwerk Manufacturing Businesses Limited. It sounds like a tiny tweak, right? But before throwing their doors open to public shareholders, they have to file some incredibly extensive regulatory paperwork.
You'll often hear financial analysts throwing around the acronym UDRHP. It stands for Updated Draft Red Herring Prospectus. Sounds complicated, but it's essentially just a massive disclosure document filed with a securities regulator. The red herring part, that simply means it's a draft. It purposefully leaves out the exact final price of the shares and the exact final quantity that's going to be issued. Basically, the company uses this to gauge market interest before locking in all those final details. And today, we are analyzing this very document.
Moving on to Section 2, decoding the IPO numbers. The scale of the offering.
Just look at that number on the screen. That is 26,000 million rupees, or 2,600 crores. According to the prospectus, this is the maximum size of what they call the fresh issue. I mean, that establishes the sheer immense financial scale of this event. But it really makes you wonder, what does fresh issue actually mean for you as an everyday investor?
Well, this brings us to a really crucial question for this specific deal. Where does your money actually go? Let's take a look at how this mountain of capital is being split up.
All right, so on the left side here, we have the fresh issue. That's the 26,000 million rupees going directly to Zetwerk to fund their actual operations. Think of it like buying a ticket directly from the concert venue. The venue gets your money. But look on the right. The document states up to 96.8 million shares are being sold as an offer for sale, or OFS. These proceeds, they go straight into the pockets of existing early investors. Zetwerk itself doesn't see a dime of that money.
Now, the prospectus outlines what's called a 100% book-built offer, and the breakdown is pretty wild. A massive 75% of this is reserved for qualified institutional buyers. We're talking massive mutual funds, huge insurance companies, the big players. Another 15% goes to non-institutional bidders, but take a close look at that final allocation. Only 10% of this entire offering is actually reserved for everyday retail individual bidders. Honestly, that tells you exactly who this IPO is truly catering to.
Which brings us right to Section 3. Who is cashing out? The offer for sale.
Looking at these selling shareholders is just a fascinating study in how venture capital works. For example, promoters like Amrit Pratikacharya are offering over 14.2 million shares, and their listed acquisition cost, literally negligible. We're talking less than 1 single paisa per share. Then you've got the institutional investors. Peak XV Partners is selling 8.4 million shares that they acquired at an average cost of just 6.31 rupees each. Excel India's cost was 7.84, and Kai Capital came in remarkably low at just 3.94 rupees. Now, obviously, we don't know the exact final IPO price yet, but it is guaranteed to be exponentially higher than these tiny acquisition costs. A truly massive payout for these early investors is clearly lined up.
All right, let's pivot to Section 4, the Wall Street heavyweights, book-running lead managers.
So deep in the prospectus, you'll find the financial architects behind all this. They're called the book-running lead managers, or BRLMs. Think of them as elite financial project managers. They're the ones helping the company set the price band, marketing the shares to all those huge institutional buyers, and just generally making sure this complex regulatory machine actually works. They are completely steering the ship here.
And Zetwerk? Well, Dave hired the absolute biggest names in the business. Having massive domestic and global giants like Kotak Investment Banking and Morgan Stanley running the books, that is a huge visual signal of the institutional scale and the sheer seriousness of this deal.
And they aren't going at it alone either. The roster continues with heavyweights like Goldman Sachs and HSBC. Now, these banks aren't doing this out of the goodness of their hearts, for sure. The prospectus clearly notes that the company and the selling shareholders will share the costs and fees paid to these managers. Having this kind of banking muscle definitely helps build confidence among institutional buyers, but, it also highlights the incredibly aggressive push to ensure this massive stock sale is a total success.
Let's bring it all back down to earth with Section 5, Understanding the Risks. What could go wrong?
Okay, let's rapidly fire through the top warnings the company itself is giving you in this document. First up, this is their first public issue. That means there's absolutely no prior formal market for these shares. The IPO price might not reflect what the market actually thinks it's worth once trading begins. Second, they explicitly warn of a high risk of extreme price and volume volatility. They state outright that there's no assurance an active trading market will even develop. You could theoretically lose your entire investment. Third, we see our earlier point reiterated as a formal risk here. The proceeds from the offer for sale do absolutely nothing to benefit the company's growth. And fourth, here's a really interesting note buried deep in the fine print. The industry reports painting this rosy picture of the market in the prospectus, they were actually paid for and commissioned exclusively by Zetwerk for this IPO. It's a sobering reality check that definitely grounds the whole narrative.
So that leaves us with one final big question. We've seen the impressive scale, the elite Wall Street banks, and the massive fresh issue meant to fuel future growth. But on the flip side, we've also seen a staggering amount of early venture capital cashing out at rock-bottom acquisition costs, right alongside some very real, documented risks of volatility. As an investor, you have to weigh this stuff carefully. Is jumping into the Zetwerk IPO a meticulously calculated risk based on manufacturing growth, or is it simply a leap of faith fueled by market hype? The prospectus gives you the data, but ultimately, the decision is entirely yours. Thanks so much for joining me on this explainer today, and I really hope this deep dive helps you navigate your own portfolio strategy with just a little bit more clarity. Catch you next time.